Today is Wednesday, May 6th. The Dow is at a crucial area. We're at the 24,000 area. It could go either way. But whichever way it does go, we'll be right on top of it. This move is very important. A breakout above 25,000 is going to be very bullish for everybody. What we don't want to see, we don't want to see the Dow going under 23,000. I'm going to show you a chart up here, and it shows you what happened just before the crash and why I did not get caught in the big drop. I had a very important support line, and once it broke through the support line, there was nothing stopping it from going down. What I did not know is how fast it was going to go down. No one expected the Dow to go down from 29,000 down to 18.5 in such a short period of time. We're talking like 2 or 3 weeks. I did a calculation, and my downside objective was 18,500. It hit 18,250.
Hey.
All right, now, we use halfway points to determine the next move in the market. Like 50% move. For example, if a stock went from 20 to 30, a normal reaction would be the stock to come down to 25. In this particular case, the Dow was at 29.5. It went down to 18.5. So the halfway point is right around 23,000, 24,000. This is a normal move. Now the next move will be very important, because if this thing breaks out, we can get into new highs. And if it breaks down, okay, we're going to go down and test the lows, and for the long haul, that's not good. See, here's what I'm showing you. The most important thing on this chart is the moving average convergence divergence. We call that the MACD indicator. This is like a zero line, all right? This is like a battle line. When it goes underneath the zero line, it's negative pressure being put on the market. They put so much pressure on it, then it kind of rolls, then it rolls over a little bit, and it starts going the other way. So when we see it going the other way, that means we know the market that's a signal for the market to go up. So then it goes above the zero line here, okay? We go here, and then we see it rolling over, then it goes down here, accordingly. But this point here, it didn't go under the zero line. So you look down here and see what happened after that. When the pressure starts going this way, this thing here goes straight up here, stays up here. We call this a positive divergence here, where this went lower, this thing did not go lower. This tells us the market's going to turn around. So it keeps going up, keeps going up, keeps going up. Now, from this point here to this point here, this went higher. From here to here, this hit a new high. This indicator went here. It did not go high, it went lower. So we call this a negative divergence, okay? Once this pressure starts going down and it goes under the zero line, see what happened here? Down, 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 and then negative pressure. Down here, what happened? This date, I think, is 1 May. We're not totally up to date here, a couple of days behind. This eases up. When this eases up, it turns around. Guess what? The Dow goes up 300 or 400 points. So this is the sequence. Above the line is positive, negative, positive, still positive, still positive. Now we have what we call a negative divergence. I'll say it again. The index goes higher, but this index, the Dow goes higher, but the MACD does not. That is a signal that we're going to turn around and go this way. The pros do this all the time. They go back and forth. This is their tracks. This is how they do it. This is the number of volume. The black lines here is positive volumes. The red lines are negative volume, all right? When you have positive volume, the Dow can only go in one way. Once you have negative volume coming in, negative, see how they do it here? Then at the very bottom, right, it stays there. This thing puts pressure on, and then it eases up the pressure. Then look at this, starts turning the other direction. This is the way they do it.
Excellent.